Yes, people, a very happy to all of you. So, guys, we're going to begin with a brand new series called as Company Accounts. So, this series usually comprises of 3 seasons. 3 seasons. Fortunately or unfortunately, the third season has been deleted. So, the very first, wait. 12 CBSE people deleted. After COVID, constantly it has been deleted. And CA Foundation students, you're lucky that this old scheme, this is not there. But next examination onwards, which means the current 12 people, next time when you give CA Foundation, this villain will meet you there. Now, from the board examination point of view, this chapter has got a good amount of weightage. Accounting for company, comprising of 2 chapters. One is issue of share capital and second is issue of debenture. These two put together carries a weightage of 24 marks from the board examination point of view. And this particular chapter from the CA Foundation point of view also carries a good amount of weightage. So in CA Foundation, what weightage it carries, I'll be discussing in the CA Foundation class. Now, so let me reiterate my point one more time. So in the company accounts, we are primarily going to deal with 2 chapters. One is accounting for share capital. Second is accounting for issue of debentures. Accounting for share capital is going to take good amount of time. And once this chapter is understood properly, replica of this chapter is accounting for issue of debentures with slight changes and modifications. But it is very easy. People somehow have a phobia with this topic, especially certain concepts are quite tricky. So definitely those concepts I'll put in certain way, which will become easy for you to understand. And one more important thing that a lot of students miss out here is the theory part. A lot of schools or a lot of people skip the initial theory, which I'll be focusing on in the very first 3 classes of your company accounts, which is very, very important, because for 12 CBSE people this can come in form of MCQ, it can come in form of accession based questions, it can come in form of case based studies. So we cannot deviate from the theoretical aspect. And for CA Foundation people, this could be comprised and asked in form of your true and false related questions. So theory again plays a very, very important role. So this is, guys, company accounts, accounting for share capital. So in this particular chapter, we're going to understand, first of all, what is the meaning of a company. A company carries what kind of features or characteristics, very, very important, again from theory point of view. Second, what is the difference between partnership and the company? What are the different types of companies? What does incorporation of a company mean? What is the meaning of share capital? What are the different types of shares? Like that, the list goes on and on and on. So I would rather like to discuss all this as and when we come across. So let's begin, guys. Before I start discussing what is the meaning and the definition of company, I would like to bring your attention to this particular point. Guys, all of you remember when I did the partnership, I said you that in India, if you're doing business, the business needs to have a particular form. You should have a particular body or a shape for you to carry out the business. So there are various forms in which you can operate your business. The first form being the most preferred form of doing business is sole proprietorship business. The sole proprietorship business suffers with certain limitation. To overcome that limitation, to overcome that difficulty, people look up to forming a partnership. Partnership again suffers with certain inherent limitation. To overcome that, people look up to forming the limited liability partnership. In limited liability partnership, there is certain limitations. And to overcome such limitation, people look up to forming companies. And then like there are one more variety called as NPO, but this is a non-profitable organization. NPO stands for a non-profit organization. So the above what I discussed, sole proprietorship concern, partnership, LLP and company is a profit-making organization. NPO is form of doing business, but the motive is non-profit. So how do you form a trust and society under an NPO? That is something which I'll exclusively discuss in the NPO topic at the foundation level, because in 12th CBSE level, this is be Swaha. Now, what is a sole proprietorship concern? Guys, sole proprietorship concern is a concern where one person gets the thought of doing a particular business. He's got that seed idea of forming a business or doing a business in a particular way. He's the person who contributes the capital that is required to start the business. He is the person who manages the entire business. He is the person who will reap all the profits at the end. So this is basically a one-man show. A sole proprietor, everything he does by himself. But this you can do up to a certain level. When a business grows beyond that limit, then a sole owner cannot manage such kind of organization. So here the sole owner suffers from certain inherent limitation. The example being, he will suffer. First example is he suffers what?
A lack of capital.
Capital shortage. Exactly the point. As a sole owner, you would have the capacity to invest, let's say 10 lakh rupees, 15 lakh rupees, 30 lakh rupees, 50 lakh rupees, or we can go 1 CR. But there are certain businesses where this 1 crore rupees is not sufficient. For example, let's say I want to construct 300 apartments. So to buy such a huge land, to construct that many floors, how much money is required? Is 1 crore sufficient? No. Then how do I pool money? As a sole owner, he will invest his money. Second, if that option is not available, he'll go for bank loan. But how much money will go for bank loan? On top of that, if you take loan, there's a burden of interest until you construct the apartment, until you sell the apartment, you have to keep on paying the interest. So it's a burden on your head. So any businessman would not want to take such kind of risk. So he finds a different ways or form in which he can pool more people as an owner, as an equal owner who can invest in the business. So in sole owner or sole proprietorship business, the problem is that only one owner can do the business. So there is a lack of capital. There's a capital constraint. So to overcome that capital constraint, he will look up to either forming partnership concern or limited liability partnership concern or a company concern. So the first constraint that a sole owner faces is the capital constraint. Second constraint, management constraint. Now, let's suppose FFLA currently is established in Coimbatore. I want to have multiple branches across Coimbatore, or I want to have multiple branches across Tamil Nadu, or I want to have multiple branches across India. Then 1%, do you think it is easy for me to manage all the branches? You may say that, sir, you can put an employee and he can manage. But definitely employees required, he will manage. But in the respective areas, there has to be a person who takes care of it with the utmost responsibility and accountability. The accountability and the responsibility with which a owner works, can you expect the same accountability and the responsibility from the staff? Not possible. So definitely you need to have an owner in the respective areas who can equally take care of the business in those areas. So sole owner faces a management constraint. So what happens? He looks up to forming either a partnership concern or a LLP or a company so they can get more owner into the business. So like that, there are various limitation that is being suffered in the sole proprietorship concern. Then comes your LLP. So LLP is what? How did the birth of LLP happen? Since there was a constraint in the sole proprietorship concern, since only one owner was allowed in the sole proprietorship business, to overcome that constraint, and partnership concern or a partnership type of business is being allowed to be done, wherein two or more people come together with the intention of doing the business and enjoying the profits. But here also there is a constraint. In partnership also there is a constraint. Again, what happened? Capital constraint. In partnership, what is the minimum number of partners? Two. Maximum? Maximum is 100. The Companies Act has given the central government has been given the power that you can have maximum 100 partners in the partnership firm. But the central government has utilized that option and they have restricted as of now the maximum partnership to the limit of 50. This is what you've studied in the partnership topic, which we winded up in the last class. So minimum 2, maximum 50. Now imagine I want to construct 300 apartments. The same example I'm taking. Sometime the 50 partners also is not sufficient. You might need 100 partners or 150 people contributing to the capital, because 300 apartment, imagine the size of the land I have to procure. Imagine the amount of money that I have to pump in for constructing those apartments. So sometimes even 50 people are not sufficient to pool the money. We need more hands. We need 100, 200, 300, 500, 1,000 people to join hands together to form the business. So here the again inherent limitation is the ownership. There's a restriction in the ownership. In the partnership, maximum owners that they can form is 50. If you want to go beyond 50, then you have to look up to forming a company. So again, there is a ownership constraint. With the ownership constraint comes the capital constraint. Limited partners, limited capital. So capital constraint. Again, management constraint. Now, same way, guys, if partnership wants to have so many branches across so many places across India, let's say I want to open 150 branches all over India. Do you think that 50 people will be able to sufficiently manage those branches? Very difficult. So if you want to expand or you want to do more management, probably you look up to forming a better or bigger kind of organization. So like that, partnership also suffers with certain inherent limitation. But of this all, there is one major limitation which has been suffered by the partnership concern, which is unlimited liability. What is unlimited liability?
They are jointly and severally liable.
Now, if the assets of the firm is not sufficient to pay the liabilities of the firm, if the assets of the firm is not sufficient to pay the liabilities of the firm, then such liability holders will attack the private properties of the partners. So this we have studied in which topic? Last topic, which is dissolution. In dissolution, we studied that we saw an example where the assets of the firm, when they sold, since few people did not attend the partnership dissolution chapter, I'll just give you an example. So this is the firm's balance sheet. Asset is 25 lakh, capital is 5 lakh, external liabilities 20 lakh. Now guys, the book value of our assets is how much? 25 lakh rupees. Book value of assets is 25 lakh rupees. When you go and sell this assets in market, there is 3 probability. You may either get exact 25 lakh rupees, or you may get more than 25 lakh rupees, which is 30 lakh, or you may get less than 25 lakh rupees, which is 15 lakh. When you go and sell assets in the market, do you think the book value of the assets what you have quoted in the balance sheet, the same value will fetch it? There's no guarantee. You might get the same value, or you might get the more value, or you might get the less value. Imagine a scenario. The assets what you're willing to sell is only fetching 15 lakh rupees in form of cash in bank, which means 25 lakh worth of assets in your book. When you're about to sell or when you sold it, it only realized 15 lakh rupees. How much money is there in your hand? 15 lakh rupees. What is my external liability? Let's say this external liability is the bank loan. 20 lakh rupees is the bank loan. In that 15 lakh rupees I have settled by selling all my firm's asset. Still 5 lakh rupees is unsettled. Now, since the firm enjoys the status of being called as unlimited liability concern, now the banker, for recovering the 5 lakh rupees, he will attack the private assets of the owner. Private assets of the owner. So this is one of the inherent limitation, biggest limitation of the partnership concern. That is why some people do not prefer to form a partnership concern. Rather, they prefer to form either a LLP or a company. About the unlimited liability, this practical example, I have been dealing in depth in the dissolution topic. So I don't want to waste the time. If anybody wants to understand this a bit more in detail, you can watch the initial 2 or 3 lectures of dissolution. That will give you a complete clarity. Limited liability partnership, once again, limited liability partnership, I'm not discussing because this is not in your syllabus as of now. So we'll skip it. Then, looking at the inherent limitations of the partnership concern. Now people want to look up to forming something, where they don't have a constraint, they don't have a limitation. So that's when people look up to forming a company. So company here has got slightly a bit more advantage than partnership concerns. So here company is again of multiple varieties. There are 3 varieties of company. One is called as OPC, one person company. Then we have private limited company. Then we have public limited company. So all these 3 I'll be discussing in depth when I start the chapter. Sir, have you not started the chapter? I'm just giving an outer line. I'm not started. I'm just giving an outer line. So in depth about the company, I'll be discussing now. Somebody online called me for the doubt. What is it? No doubt? Chalo. Meaning and definition of a company. Mark this very, very important. A company is also called as joint stock company. So often people get confused that company is different, joint stock company is different. No, both are same. A company is also called as joint stock companies. Why it is called as a joint stock companies, you will eventually understand once you understand the meaning of the companies. A company is an association of the person. Association means what? It is a formation of multiple people. So multiple people come together and form the company. It's an association of persons formed and registered. Mark the word, guys. The word is registered. Registered under the Companies Act 2013. So this word registered, we have come somewhere across in the partnership topic. In partnership, what did we learn? It is compulsory to have the agreement. The agreement can be either oral or in writing, but agreement has to be there. The compulsion was an agreement. Nowhere they said that the partnership deed should be registered. So in partnership concern, the partnership deed registration was optional. Registering of partnership means what? Registering with the government authorities. Whenever we talk registering with whom? With government. That was optional in the partnership. Whereas in the company accounts, it is compulsory. In fact, you cannot form a company, or a company cannot come into existence without being registered with the government authority. Here the government authority is ROC, Register of Companies. I'll be discussing in the upcoming classes. So a company is an association of person formed and registered under the Companies Act 1956 and 2013. So what is 1956? What is 2013? I'll explain. Second, it is a legal person. Sir, how can company be called as a person? Person means only human being, na? Can I call company a person? Yes. Yes. Who has given the status of artificial person? It is the government who has given the status of being called as an artificial person. Now, why a company is called as artificial person? What is the significance of being them called as artificial person? We'll understand in today's session. So a company is a legal person. Legal means what? This is a person created by law. We are created by nature, by God. But a company is created by legal law. So it is a legal person not having any physical existence. Is there any physical existence of a company? Not at all. So it is a legal person not having physical existence and has a separate legal entity concept. Separate legal entity means what? In 11th we studied, no? Business entity concept, accounting entity concept. What does it say? Account from the business point of view, not from the owner point of view. Here, they've modified the language. So here you'll come across the same concept, but different terms. Because the formation of the company or the person who created this concept, he believes that we should be known by the fancy names. So you'll come across a lot of fancy names. So separate legal entity means nothing but business entity concept and accounting entity concept. A company is a legal person not having physical existence and has a separate legal entity. That is, it is an artificial person separate from its members and shareholders. So one concept is what? It is an artificial person created by law. It is an artificial person created by law. And because of the separate entity concept, company is different from its owner. The owner here is not called as owner. Owner here is not called as a partner. They are called as shareholder. They are called as member. Fancy name again. It normally has a share capital divided into units called shares. Okay, now before I start explaining what is share, what is shareholder, what is owner, what is member, before that, till this point, you have any doubts? Yes, boss.
So there's many people have like invest in share market and all
Wait, don't go till that. I have to explain a lot of things. In this point, if you have any doubts, you ask. So first thing I told you, company or joint stock company is same. Second, a company has to be registered. Then a company is a legal person, which is also called as a artificial person, which does not have a physical existence. And second, it is known by separate legal entity concept, which is different from its owner. So company is different from its owner.
If a firm is registered, like it's not compulsory, but if it does that make it a legal person?
Okay, the question that arises is that, sir, a partnership concern, if registered, what is the status? If not registered with the government, what is the status? The status is still legal person only. But if you're registering the partnership concern with the government, it has got certain benefits. So especially if you want to file any suit or case, a concern which is registered with government has got little bit more weightage than you don't have a registration. Now people get confused. They think that the agreement is made on the stamp paper. So making a stamp paper means what? It is registered. No. Creating the stamp paper, and on that if you write the terms and conditions, that is called as partnership deed. Now you have to go to the registrar office, get a stamp on it, pay the stamp fee. That process is called as registration. Am I clear? Now, sir, what is shares? This has been fascinating us for a very long time. So if I want to understand share in one single line or one single word, what that would be? I want from a layman point of view. Tell me.
Profit.
She killed it.
A part.
Of capital.
Share means what?
Part of the company.
A part. A piece.
Part, a piece. The part and piece of what? Cake?
Intangible assets.
Intangible assets.
Owner's funds.
Owner's funds.
Part of ownership, sir.
So it's the final, like,
It's a small unit.
Small unit.
Part of share.
Part of share.
Sir,
Layman
ownership,
language.
sir.
Layman, you understand what is layman?
It's a part of capital.
Okay, wait. Wait.
Division of
Layman
capital.
means if I go and ask a science person what does a share mean, he should understand. Like that you have to tell. If you tell unit, if you tell part, put, then he'll go away.
Buying and selling of goods that you can't see profits.
Tangalma.
The division of capital.
Online somebody said something.
Profit.
The division of capital.
Share is nothing but, in layman language, share of profit. Share of profit we learned where? Partnership topic. ABC, 3 partners formed a partnership concern, sharing the profits in the ratio 5:3:2. So share is nothing but, in company, shares means share of profit only. In partnership, what happens? The share of profit, what you determine, it is not necessary that it should be proportionate to the capital contribution. It can be. The capital ratio, the capital contribution ratio and the profit sharing ratio can be same, but it's not necessary that it has to be same. So we've seen a lot of questions where the capital contribution is different. For example, ABC are 3 partners. Each contributed 2 lakh, 3 lakh and 5 lakh. So what is the ratio? 2:3:5. This is the capital contribution ratio. It is not necessary that the profit sharing ratio also should be same. Profit sharing ratio can be different because in the partnership concern, the profit sharing ratio is determined based on the hard working. Who is working hard more, he'll get more share of profit. Correct, no? Correct, no? So here, shares means share of profit only. In companies, shares means share of profit. But in companies, the share of profit is calculated based on the amount of capital that you contribute. I'll explain it. This, if you see this circle, this is the total capital. This is the total capital. This is the total capital of the company. This is the total capital of the company. In all this diagram, you will commonly observe one thing, that these are the group of people, 1, 2, 3, 4, 5. So 5 people are contributing money to the total capital of the business. To the extent they contribute the money, to what extent they contribute the money, to that extent they get the piece of share in profit. So let's suppose these 5 people. So total capital contribution is 50 lakh rupees. The total capital required by the company is, let's suppose, 50 lakh rupees. Total capital to be contributed is 50 lakh rupees. How many people are contributing this?
10 people.
5 people. Why 10 people? So much hard work I should do. Huh? 1, 2, 3, 4, 5. Person A contributed 10 lakh. Person B contributed 15 lakh. Person C contributed 5 lakh. How much happened? 30 lakh?
30 lakhs.
Okay. Person D
20.
10 lakh. Person E 10 lakh. 50. Now, the total capital of the company, is 50 lakh, which means if I have to start the business, I need how much money? 50 lakh rupees. But one person contributing 50 lakh is very difficult. So they ask for multiple people to contribute. So like that, we identified 5 people. So each one is saying that I'll contribute so much depending on their capacity. How much each one is having capacity, they'll contribute that much of capital. So here, 10 lakh rupees, if they've contributed, means how much percentage they've contributed? 10 upon 50 into 100. How much? 1 by 5 is how much? 20%. So 20% of the capital is contributed. So what capital is contributed, to that extent he's getting 20% share in the profit of the company. So which means whatever the profit company is earning, how much is share of profit? 20% will be the share of profit. So in the companies, your share of profit will be proportionate to the amount of capital that you contribute. Am I right or wrong? Am I clear with what I'm saying? Now this fellow, 5 lakh is contributed out of 50 lakh. So 5 divided by 50 into 100.
10%.
This fellow is contributed 15 upon 50 into 100, which is
30%.
30%.
this is 20%.
20%.
20%.
If you add all this 5, it becomes equal to 100%. So what do we understand, share? Sir, 50 lakh rupees is the total capital of the company, which is divided into smaller units called as shares. To be more precise, now this 10 lakh capital what has been contributed, now here, this contribution has been done in a very fancy way. Actually, what is a fancy way? Now here, this 10 lakh rupees is there, no? Like a product they will treat. Share is treated like a product here. So here, 1 lakh. So if you are going to invest 10 lakh rupees, example, 1 lakh shares. Each shares is of the value 10 rupees. So 10 lakh rupees is the amount that you have to contribute. This is like a chocolate. This is like a chocolate box. If you want this chocolate box, in this chocolate box, there are 1 lakh chocolates. Each chocolate is costing how much? 10 rupees. So total 10 lakh rupees you have to pay to get the entire box. So like that, this capital is being, divided or explained in a more fancy way. Now, why this has been done? The beauty of this shares, number of shares, if you, want to understand, when you understand this entire concept, you really appreciate the beauty of why this has been derived. This 1 lakh shares into 10 rupees, which is just 10 lakh rupees. This concept you will really appreciate when you understand the entire concept of the company accounts. So here what happens is that now the same 50 lakh rupees, guys, I'm telling that I'm dividing this into 10 rupees per share. Each share 10 rupees. So how many shares I can issue? 5 lakh shares. 5 lakh shares. Each share is value 10 rupees. Sir, is it necessary that the share value should be only 10 rupees? It can be 1 rupee, it can be 10 rupee, it can be 50 rupee, it can be 100 rupee. So who decides this 10 rupee? It is the company who decides. So instead of making it 10 rupee, can I make it 1 rupee? Yes. So in that case, it becomes what? 50 lakh shares. So now what happens? 5 lakh shares the company is having. Company says that if you want to be a part of my company, if you want to become the owner of my company, you have to buy the shares from me. And each share is costing rupees 10. So now the same 5 people. A says that I have 10 lakh rupees in my pocket. So how much shares he has to buy? 5 lakh shares. This is number of shares. Each share is worth how much? 10 rupees. So price per share is equal to total capital. So what is total capital? Number of shares into price per share is the total capital. So 5 lakh into 10 rupees, how much? 50 lakh. Now guys, company says that 5 lakh shares I'm going to give you. How many of you want to come and apply for my shares? You can come forward and take that many number of shares. So A says that, see boss, I have 10 lakh rupees, which means he will buy 1 lakh shares from the company at the rate of 10 rupees each share. So total money that will invest is 10 lakh. So why this 1 lakh shares is being given? So that it becomes easy. So if somebody wants to invest 5 lakh rupees, he will say, I want to buy 50,000 shares. So it becomes more easy for trading purpose. Now, once you understand the complicated part, when we come to public limited company, how the share market functions and all, that time you really appreciate this concept of number of shares. This concept of number of shares is not there in partnership concern and sole proprietorship concern, because the capital of the partnership concern, the capital of a sole proprietorship concern is never traded in the share market. But the capital of the companies, that too specifically the public limited company, is been traded in the share market, and for that trading purpose, this quantity is very important. Today, if I want to buy Reliance Limited shares, so I want to say I want to buy 10,000 shares of Reliance Limited. I want to buy 100 shares of Reliance Limited. So for ease of trading purpose, they have bifurcated this 50 lakh rupees total capital into smaller unit called as shares. Are you able to follow? So now B wants to invest in the company. So B says that, okay, look, I want to buy 50,000 shares of your company. So 50,000 shares into 10 rupee each share. How much money he has to invest? 5 lakh rupees. So it becomes easy for him to buy the shares of the company. So when you have the quantity of the capital given, it becomes easy for you to trade. Buy and sell becomes easy. So coming back. It normally has a share capital. Means what? A company has a share capital. Share capital means what? A capital that is being shared by multiple people. That is called as a share capital. What is the meaning of share capital? A capital shared by multiple people is called as a shared capital. So in our business, we wanted 50 lakh rupees capital. How many people shared it? 5 people shared it. A, B, C, D, E. This is called as a share capital. This 50 lakh is divided into smaller unit called as shares. How many shares we gave? 5 lakh shares. The unit value is how much? 10 rupee per share. So 50 lakh I divided by 10. I got how much? 5 lakh is the number of shares. The owners of which is known as members. So the person who contributed this capital, the person who purchased the share of a company, A, B, C, D, E, are called as members, are also called as shareholders, are also called as owners. Which means, sir, if in the share market, if I buy the shares of Reliance Limited, then am I called as owner? Oh, am I equal to Mukesh Ambani, sir? So if Mukesh Ambani drives his Rolls Royce vehicle, which means I can also jump onto this vehicle because I am also the owner. Can we do that?
No.
The security guard will kick you out. You are an owner, but you are a dummy owner. You don't have any weightage. Now, why you don't have a weightage, you'll understand when we do the upcoming chapter. So every person who invests in the company is called as a shareholder. He buys the shares of the company, which means he's contributing to the capital of the company. Till this, any problem? Till this, any problem? No problem. Can I go forward? Okay. Now, insolvency. What is the meaning of insolvency? Bankrupt, pauper. Insolvency or death of a member. Member means owner. So A is a member who has invested the money. How much money he gave? 10 lakh rupees. He became insolvent, bankrupt, or he died. Do you think his death will affect the company's going concern? Will affect the business? But same thing. In case of partnership, there are 5 partners, A, B, C, D, E. If one dies, the business has to be dissolved. Have you studied this or not? If the firm should not be dissolved, then in agreement you have to make a specific clause that death of a person should not affect the going concern. Like that, if you maintain a clause, then only upon a death the business or firm is not dissolved. But if you forget to mention that clause, upon a death of a partner, the firm has to be dissolved. Did we learn that point or not? So here in the agreement, when you form a company, in the agreement, whether you make this point or not, by default law says insolvency of a person, death of a person will not affect the continuity of the company. It will not affect the going concern of the business. The business can continue without any problem. Who is giving that authority? Law is saying. So in the agreement, specifically, even if I don't mention the point that whether a person dies, the company will continue or not continue, even if I don't mention the point, still law says that we are protecting you, the company, you can continue your business. Are you able to follow? So insolvency or a death of an owner will not hamper the going concern of the business. The business will continue as it is. That is, the company continues even if the member becomes insolvent or dies. Point clear? Now, Section 20, subsection 20 of the, Section 2, subsection 20 of the Companies Act 2013 says that company means a company incorporated under this act or any previous company law. Now, listen to me very carefully. This Companies Act, first of all, what is the meaning of Companies Act? What do you mean by act? If I have to explain in a very layman language, since most of you 12 people here, you have not studied law. So in a layman language, act means what? Law equal to a rule book. Yes, when an organization, such a big organization is formed, obviously there is a lot of confusion. What to do, what not to do. If this happens, what to do. If that happens, what to do. Like that, there'll be a lot of confusions, no? So if you do not regulate, if you do not put rules and regulations across, then what happens? People will do as they feel like doing. Correct? No? So in India, we are surrounded by law. I've given this point n number of times. Now here in this premises, you are governed by the rules and regulations of. The moment you step out of this premises, you are governed by the building complex. The rules and regulations laid down by the complex. The moment you step out of the road, on the road, you are governed by the rules of RTO. From there, you get into the apartment. You're governed by your rules and regulations of your apartment. The moment you get inside your home, still no control with you. The control is with your parents. Then again you get inside your bedroom, no control. There your elder brother or sister will be sitting like this. They will have control. The only control where you have is your bathroom. Nobody can do anything there. So we are governed by rules and regulations everywhere. Same way, guys. While a company is being formed until the company is dying, and in between, when the company is doing all the business, there's a lot of confusion and chaos. For all the confusions, the go-to place is Act. If you have any confusions, any doubts relating to anything, you will go and refer the rule book called as Companies Act. Sir, when was this Companies Act first formed? This Companies Act was first formed in the year 1956. When I did CA in 2009, 10, 11, that time we were following the rules laid down in Companies Act 1956. But the problem is 1956, where is 1956, where is 2010, 11, 12, 13? So what happened over a period of time, the way the people were doing the business, the way people were thinking, everything underwent a significant change. So a lot of experts felt that this 1956 law is outdated. We cannot apply that law in the current scenario. So it is requiring a major revamp. So in the 2013, after so much of battle at the parliament, finally in 2013, they launched a new Companies Act 2013. So, sir, from 1956 to 2013, there were no changes. Yes, after 1956, every year constantly there were changes, but that changes were not sufficient. That's why they had to cancel the whole old law and create an absolute new law. And from 2013 till now, we are in 2023. It's been exact 10 years. Since then, there's a humongous change in the company's law. Every year there is a change. Complexity has been increased. But why do we refer still this as 2013? Because this major law was laid down in the year 2013. The major revamp was done in 2013. And till now, it is only the updations that is being happening. So today, the Companies Act and rule book that you'll follow will be Companies Act 2013. Am I loud and clear? So now the question says that, or this definition says that company means a company incorporated under this act. This act means what? 2013 or any previous company law. Now, why this point is very important is because all the company which got incorporated or registered after 2013, no problem. The question that came is all the companies which is registered before 2013, they asked, should we die? After you brought a new law, we are 1956 registered people. So should we die in the market? So then they said that all the people, those who have registered under old law, you are carry forwarded in the 2013 Act also. So you are also company. As per us, you are also company registered under old Act. So that's why this definition was very, very important. Second definition was given by Professor Hanning. It says that a company is an artificial person created by law, having separate entity with a perpetual succession and a common seal. Now this is one line, no? If you allow, I can talk on this one line for 1 hour. Because all the points that I've circled, is the characteristics and features of a company, which I'll be explaining in the upcoming page. Characteristics and features of a company.
So I had a doubt.
1 second, Kana. So, for example, artificial person is been covered here. What is the meaning of artificial person? Then here, separate entity, separate legal entity. Then we have perpetual succession. So, perpetual succession is being explained here. Common seal has been explained here. So, this is that important because from the theory point of view, whether it is 12 CBSE, MCQ, case-based studies, accession-based question, of a CA foundation, true and false point of view, this particular concept holds very, very important and strong. Now, online, somebody asked me for doubt. What is it?
Sir, can you scroll up once? So in this one, the company means a company incorporated under this act to any previous company law. I didn't get one thing. So when the companies which are formed with 1956 Act, in 2013, what do those companies do?
So, company means a company incorporated under this act in 2013 or any previous law which is 1956. So now problem is in 2013 law, what they said that anybody who's registering from 2013 and onwards in the new scheme, you will be registered and called as a company. So the problem that arises is that all the people, those who were registered in the old law, so what is their status? So do they need to do any changes or do they need to do any conversion? Then the law said that no need to do any conversion. Even if you are registered under any previous company law, we will consider you as a company only and you can continue as it is.
So if there's
But the
something,
rules and regulations what will be applied will be 2013. Though you are registered under the old law, but from now onwards, the rules and regulations what you will follow is the 2013 ka rules and regulations. Yes, Nishka. Now tell me.
so if there's anything conflicting in the
Not
2013
at
and
all. Not at all. They have done a very smooth transition. No conflict at all.
so basically the companies 1956 will continue to exist, but they will follow the rules and regulations 2030.
Absolutely. That's right.
Okay, thank you. Sir.
Now, the first and the foremost important point, incorporation. A company is an artificial person created by the process of law, that is the Companies Act. Now, guys, for incorporation, there's separate procedure. How the incorporation works, I'll be discussing probably not in next class, the next class after that. The third class, I'll be discussing the incorporation procedure, which I'll explain nearly about half an hour to 40 minutes. So there is a step-by-step procedure that you have to follow, upon following which the company will be legally registered. And upon registering only, a company will be called as an artificial person and it will come into existence. So the very first step is what? You have to submit certain documents. Then after checking the document, the first level is completed. Then they'll give you one certificate. Then after that, you have to do certain more activities, what they say. After doing that, you get one more certificate. And upon that only, your formation of the company is being completed. So once the registration process is completed, that is the date when it's the company is born. So the date of birth of the company is when the registration process has been completed, when you get the certificate of incorporation. What is certificate of incorporation? I'll be discussing in the upcoming classes. So a company is an artificial person. We have studied this concept in the golden rule. Personal account, real account, nominal account. In personal account, we had three categories: natural personal account, artificial personal account, and representative personal account. So who were the artificial person account? In that rule, artificial person to whom they referred? To sole proprietorship concern, to partnership concern, to company. So why the company is called as artificial person? This point you can understand when I do the third concept. The company is an artificial person created by the process of law. Now, sole proprietorship business. Is there any process that you create by law? Did law tell you any procedure that you have to follow for forming a sole proprietorship concern? No. For partnership, where there's any process, only thing they said is only you have agreement, whether oral or it could be in writing, nothing more, nothing less. So there's no as such process in the partnership concern. You did whatever you felt like doing it. But in companies, you cannot do like that. In companies, the compliances, the government compliance is humongous. You have a lot of government compliances to be done. If you don't do it, you'll be penalized. You'll be even put behind the bars. So a company is an artificial person created by the process of law. So there's certain procedure that you have to follow as per law, failing which you cannot register a company. Second point, sir, company enjoys a separate legal entity status. A company is an artificial person having a legal entity separate from its shareholder. That's why when we account from whose point of view? Business point of view, not from the shareholder's point of view. It is because of this concept. It is again because of this concept, the death of a owner does not affect the business. So separate legal entity here, if you ask me, the focus is what? Accounting from the business point of view, not from the owner point of view. That is the concept of separate legal entity, which is equal to the business entity concept or the accounting entity concept. Is the second point clear? The company is called as a separate legal entity. Third point is very, very important point. Please concentrate. Guys, just because this is a theory, don't feel that okay, this is easy to skip, I'll easily just by heart and do it. See, by hearting doesn't make sense. When somebody is there to explain you and make you understand the concept behind each and every point, by hearting doesn't make sense. And this kind of in-depth knowledge, it is my guarantee that you will not get anywhere. How many of your schools explain this point? Perpetual succession. What is perpetual succession? Then so please concentrate. Artificial person. In the eyes of law, company is an artificial person. Why? My question goes to all of you. Why a company should be given the status of being called as a person?
To buy and sell.
Correct. Now, guys, a company is there. Let's say the company, I own it. So all the property. Now, if the company is not being given the status of a person, then if I buy the property, in whose name I'll buy? My name. So let's suppose FFLA is a company. FFLA is the company. And as per the current rules and regulations, a company cannot be called as artificial person. Now, since FFLA cannot be called as a person, if I want to buy any property where I want to take, let's say, tuition or coaching classes, I want to buy that property. Since FFLA is not a artificial person, then I'm forced to buy the property in whose name? My name. Because for buying the property, you have to mention the name of a person who's buying it. Who's the buyer, who's the seller, you have to mention the name. So now, property is purchased by whom? Me. Now, if I buy the property in my name, the control is in whose hands? My hand, not in company's hand. Now, let's say FFLA, I am the owner. Plus, along with SPJ, there are 50 of my students who have invested in my company. Now, if I buy the property and register the property in my name, who has got the complete control of the property? After a point, if I feel I don't want to run this company, what will I do? You know, I will silently, without informing any of you, I have the right to sell the property. Silently, I'll sell the property, take the money and go off. Then what will you do? But same thing if it is there in the company, I cannot do that easily. Though I have the signing powers, I have to take approval from all of you. Before I sell the property of the business, I have to take approval from all the shareholders. That boss, I'm going to do this. What do you think? Can I do this or not do this? Like that, a restriction has to be laid. So therefore, it's the law, that is the rule book said that it is very important that we have to give the status of an artificial person to the company so that the company can buy the property in its own name. It can enter into contract with its own name. It can do the business in its own name. It can sue somebody. If some person is doing fraud or forgery, the company can file a case in the court. Or if we are doing any fraud, somebody else can file the suit on us. Now imagine, FFLA is not having a status of artificial person. So it is SPJ and 50 of you invested in my company. Now, by mistakenly, we have done something wrong. There is a third party or some customer filing a case on us. Now, since artificial person is not existing, since FFLA is not artificial person, the outside member will file a case on whose name? On SPJ's name and the 50 other member. So because of the company, personally can we suffer? Who should suffer? Company should suffer. Who should pay penalty? Company should pay penalty. So if you don't have the status of artificial person, the case will be filed on SPJ and its members. And who will have to pay penalty now? SPJ and his members from his private money. So all this has become very complicated, no? So to save us from the complexity, we have introduced a concept called as artificial person. So company is called as artificial person because only a human being, natural or artificial, that is a person, either natural or artificial, can own the property in its name, business can enter into contract with somebody. So FFLA can enter into contract with somebody. So who will sign it? Though I will sign it, but the seal will be of FFLA. So who is the person who's legally entered into the contract? The company, FFLA. So if you want to conduct the business, if you want to sue or be sued for your debts and actions, then it is very important that a company should have the status of being called as a artificial person. Now, do you understand the significance of why a status of artificial person is given to a company? Online people, hello?
Yes, sir.
Yes, sir.
Next,
Yes,
very
sir.
important point, perpetual succession. Mark this, very, very important. Perpetual succession. There's a standard dialogue for this. In the CA that I've learned, I still remember. Members may come and go. Members means owners may come, may go. But the company goes on for ever. This status or dialogue has come from this concept of perpetual succession. Because the law feels that the death of a partner, a death of an owner or a death of a shareholder should not affect the business. So Reliance Limited is owned by Mukesh Ambani. Do you think that if Mukesh Ambani dies, his business will get hampered? His business has to be
No,
closed
sir.
and he has to form a new company? Not at all.
No.
This Reliance Limited initially was being created by whom? Dhirubhai Ambani. So after Dhirubhai Ambani died, did the companies close the company and they formed a new company? In partnership, what did they do? If a partner dies, they close or dissolve the business and form a new partnership concern. Like that, do we need to do here? No. Had this concept of perpetual existence or succession not been there, then yes. A person dies, then the business has to be closed and a new business has to be started. Guys, a sole proprietorship concern, does it enjoy the perpetual succession? Perpetual existence or perpetual succession?
No, sir.
If a sole owner dies and if his son wants to continue the business, he cannot continue in the same name. He has to close down the business and start a new business in the same name. A sole proprietorship concern is being registered with the PAN number of an individual person. A PAN number. For example, if FFLA is a sole proprietorship concern, it is registered with my PAN. If I die, this sole proprietorship concern has to be closed, this PAN has to be cancelled, and my son has to rename it same name. FFLA will rename, but it will be registered with his personal PAN. Not possible. You cannot shift the PAN ID. That is the inherent limitation of the sole proprietorship concern, and same is the case of partnership also. In partnership also does not enjoy the perpetual succession. If a partner dies, it has to be dissolved. Then a new partnership form has to be created. But there is one exception given, that in agreement, if you mention that upon a death of a partner, we can continue the business. Like that, if you mention the clause, you are safeguarded. But that too, if there are two partners only. If one dies, gone. In partnership, there are two partners. One died. What will you do? Can you run single person? Not possible. You have to dissolve the business. In partnership, this is the problem. In Companies Act, let's say there are two partners or two shareholders. In that one died, company law will give you a spare time. Within that time, you have to get another member and then you can continue. So this is a big advantage in the companies, that upon a death of a particular owner, where only one owner is remaining after that, he has been given a considerable amount of time to find another owner, and from there itself business can be further continued without affecting the business. So can it continue as a 1%? Not at all. I'll come to that. Why it is not possible. So a company has a perpetual succession. Means what? The existence is not affected by the death of a member. Death, all of you know. Lunacy means what?
Mental illness.
Mental. But don't write mental and come in the exam. If you write mental, you get mental marks only. You have to use the proper polished word. Lunacy, lunatic,
Unsound mind.
mentally retarded, unsound mind. Like that, you have to write properly and come. What a mental put in, our mental marks put there. So you have to be very careful. Its existence, that is, company's existence is not affected by the death of a shareholder, lunacy of the shareholder, or the bankruptcy. We formed a company with 5 members, A, B, C, D, E. In that, A died. Will it affect the going concern of the company? In that, B became lunatic. Will it affect? In that, C became bankrupt, pauper. Will it affect the business? Not at all. Why? Because of the concept of perpetual existence. Please make a note. This perpetual existence is also called as perpetual succession. This is another name. So don't be confused. Both are same. The life of a company comes to end only by winding up procedure by the process of law. A company will come to closure only by following up the winding up procedure. When you close the company, there are certain formalities that you have to finish with the government. Upon furnishing those formalities, or upon doing those formalities, only then you can legally close the company. Like that, you cannot close. One fine day you got up in the morning, no, I don't want to do business, I'm not going to office, the company closed. Can you do like that? Not possible. If you want to close the business, you have to legally close it. If you do not close the business legally, you have to face consequences of paying penalty, or even you will be put in jail. There's so many. When I was doing CA practice in 2017 to 2019, there's so many people who started with full Josh company. I want to become a director of the company. Oh, investing card, I'm the managing director, MD. They started the company. 1.5 years, they run the business. After that, the business was in loss. Now, to close the company, you have to pay the requisite fees, because the closing of process is not that easy. You cannot close it. You need to have a company secretary or a CA to close this process. So, a fee has to be paid. So, who will pay the fees for a closing business? So, what they did? They left the company business, everything as it is, and went. Eventually, what happened? The directorship got cancelled. Upon a directorship being cancelled, after 2 years, if you want to start a company again, you cannot become a director. You'll be levied penalty. If you don't, comply certain more other things, you'll also be jailed. So that is the heavy compliance in the Companies Act. That is the complexity. That's why when people come to me for consultancy, I used to be very careful and meticulously tell them, don't form a company unless and until your business has become super hit already. Start with sole proprietorship concern or a partnership concern. Once you feel that you have that much business, that much you've grown up, then convert your business into company, because by that time you'll have a maturity how to run a company, you'll have money to run a company. Yes, boss.
Sir, say there's a company with 5 people.
The company with 5 people, okay?
All 5 died in a bomb blast.
All five died in bomb blast. What a thought process.
So, who will be doing the final winding up procedures and how will the company come to an end?
Now the question is, there were five owners of the business. They were traveling in a car accident or car boom blast. Gone. All five died. What to do? Now law has got a provision where in law you have a provision. Definitely the legal hires can do the winding up procedure, but law also has a provision that if somebody else wants to come and take over the business, legally that is also possible. So that's why I told you a death of a member or a shareholder does not affect the going concern of the business. So if even all the people die, still the company can continue. There is a provision in the law, upon following which definitely it can be achieved. Next point, limited liability. I'll be discussing this point in depth in the third class because there's a separate topic in one particular page where we discuss about the limited liability. So as of now, I'm not discussing this. Sixth point, transferability of the share. Now understand this point. Guys, all of you understood what is the meaning of share? So here, this particular
Yes, sir.
person A has purchased how many shares of a company? 1 lakh shares of a company. Hello? Parth, how many shares is purchased? 1 lakh. 1 lakh shares of the company. B has purchased how much? 50,000 shares of a company. Now, he doesn't want to be a part of this company. He wants to come out of it. So, in the best part of the Companies Act is that he can transfer this share to somebody else and get money from him. In case of partnership concern, a partner has contributed capital. If he wants to take back the capital, the firm, everybody has to agree. If firm does not agree, he will not get his money back. So getting back the money in the case of partnership is very difficult. But in companies, it is easy. But I told you there are three types of company: OPC, private limited company, and public limited company. So of all the three, the amount that you can take out very easily is in public limited company. Whereas in the private limited company, the amount once you invest, that is the number of shares what you buy, transferring of the shares is a little bit complicated. I'm not telling it is impossible. It is possible with slight complexity. In OPC, it is not even possible. In private limited company, possible, but we have certain challenges. There are certain extra rules that we have to follow. For a public company, it is easy. So, shares of a company are freely transferable, which means what? A had 1 lakh shares. He will transfer the 1 lakh shares to another person Z. And Z has to pay the 10 lakh rupees to whom? A. So one hand give shares, another hand take money. Very easy. So shares of a company are freely transferable in the case of companies listed in the stock exchange. Now, in public company also, there are two varieties. If the public company is listed in stock exchange, then the transfer is easy. If it is not listed in the stock exchange, transfer is again challenging. I'm not saying impossible. It is challenging. So let me summarize. The three types of company. One is called as OPC. In OPC, can you transfer the share? Not possible, because
No.
1 person company, which means owner is only 1 person. To whom will he transfer? Not possible. About OPC, I'll be discussing in detail next class. Second is private limited company. In private limited company, you can transfer, but you have a star mark. You know, there's an offer in lifestyle. 10,000 rupees offer. They'll put a star mark. Star mark means what? Conditions applied. Terms and conditions applied. So here the transferability is possible, but subject to terms and conditions. Then you have something called as public limited company. In the public limited company, also two types. Some company are listed in the stock exchange. Some company are not listed in the stock exchange. So now the shares of Reliance Limited I buy. From where do I buy? From the stock exchange, because the shares of that company is listed on the stock exchange. So what is stock exchange? How does it function? I'll be discussing eventually. So here a public company shares can be transferred very, very easily and freely if such company shares are listed in the stock exchange. Very freely you can transfer, no problem. One button buy, one button sell. One button buy, another button sell. Very easy. Whereas in unlisted public limited company, you can transfer, but transfer is coming with terms and conditions. Now clear? So here what have they told? Shares of a company are freely transferable in case of companies listed in stock exchange. So which kind of companies can be listed in stock exchange? Only public limited company. Private limited companies and OPC can never be listed in the stock exchange. So if FFLA wants to register, if FFLA wants to have its share in the market for the trading purpose, then I have to register as a public limited company. Then I have to list the shares in the stock exchange. Then only I can traded, and then they can buy and sell the shares of FFLA on the stock exchange between the public. In case of unlisted companies, unlisted public company and private company, you can transfer, but transfer is subject to terms and conditions. What is the condition? It has to be regulated. It has to be approved by the articles of association of the company. So what is the meaning of articles of association? I'll be discussing this in the next class. As of now, I'll give you just one liner. Article is nothing but it is the rule book of the company, which means every company will have its own rules. Now, for example, FFLA will have its own rules and regulations. Kalpavriksha Academy will have its own rules and regulations. Some other academy, Byju's you take, own rules and regulations. An academy, own rules and regulations. So each and every company's own rules and regulations is being listed down in a document called as article of association. So if my article of association permits transfer, I can transfer. If not, I cannot transfer. Are you able to follow? Now, yes, boss.
In public companies, there are two varieties. One which is stock exchange, one which is not.
Correct. Now, 7th point, management and ownership. A company is not managed by all the members, but by their elected representative called as directors. My question goes to all of you. Online people, are you all awake or gone?
Yes, sir. Awake.
Yes, sir.
Interesting or boring?
Yes, sir.
Boring.
Interesting.
I'll give you a break. Let me give you a break.
No, sir.
Interesting or boring?
Interesting.
Interesting.
Nobody is responding. I'm telling you it is boring. I'm going. Bye.
Interesting.
Sorry. Okay, no problem. Still you learn one more time. It's fine. It's fine. It's fine. Now, Reliance Limited. My question goes to all of you. How many shareholders the company approximately has? Just roughly you tell me. 10 lakh shareholders, example.
No.
10 lakh shareholders. 10 lakh shareholders. I'm not telling 10 lakh shares. I'm telling 10 lakh owners. 1 lakh owner. If 10 lakh owner starts taking decision, what will happen? The company becomes Govinda, oh Govinda. One person making decision is fine. 2 people, little bit complicated. If 3 people comes into decision making, gone. So in a business, if there are multiple owners, each owner is trying to give his viewpoint, like do business this way, do business that way. What happened? Can you come at a decision point? Cannot come. So now imagine a point, 10 lakh owners, because 10 lakh people contributed capital, no? If 10 lakh people come and manage the business, what happened to business? Gone. So what happens is these 10 lakh owners will elect a representative called as directors of the company, board of directors. Among this director, there will be one head called as managing director. So this 10 lakh people will elect one person called as managing directors and sub management people called as directors. Now how we have ministry. Under the ministry, we have so many different types of ministry. This is prime minister. Under prime minister, we have so many types of ministry. Same way, the prime minister of the company is called as MD, managing director. Under him, we have multiple directors, multiple ministry. Prime minister, can you give one example under him what ministry is coming? Finance ministry, which is led by Nirmala Sitharaman.
Nirmala Sitharaman.
So here MD is who? Mukesh Ambani. Mukesh Ambani is the MD. Below him, there are so many directors who will do the functions of the each and every department. Are you able to follow? So all of them put together is called as board of directors. All of them put together is called as board of directors. So a company is not managed by all the members. All the owners do not manage, but their elected representative called as directors, they manage the business. Thus the management and the ownership are separate. Every person who is the owner will not manage. These owners will elect some people and those people have to manage the business. Am I clear with this point? Online people, am I clear with this point?
Yes, sir. Yes, sir.
Yes, sir.
Yes, sir.
Okay, all those who have studied this in business studies, what is common seal?
Common seal is a company. It's more like a company's signature. Company can have a.
It's like the authorization.
Is it compulsory or is optional?
Compulsory.
Optional.
A company may or may not have a common seal. Now tell studied no.
Then what was the signature of the company?
Coming, wait. A company may or may not have a common seal. Now common seal is nothing but now listen. It is basically a stamp of the company. Having the stamp of the company, it is optional. If you have it, well and good. But the way the rules and regulations have been framed by other laws, Every company is forced to have a common seal. But in law, companies law said that every company does not necessary to have a company seal, that is common seal. Just a director's signature or MD signature is equally enough. But having a common seal is advisable, is what they are saying. So company seal is nothing but the logo. It's kind of a logo. It's kind of a seal of a company. Now, there's word called as may and there's something called as shall. What is the meaning of the word may?
They cannot.
May means optional. In law, any law you read, whenever you come across the term may, you may do this means it is optional. If you want, you can do it, otherwise not required. Shall means if they say that you shall do this, you have to do this. Compulsory. So here the word they've used is may. A company may have a common seal. If it has a common seal, if a common seal has been registered, if a common seal has been applied for, then in all the important documents of the company, you have to affix the common seal. Which means what? This is the decision on behalf of the company, like that the confirmation is being made. Am I clear with this point? So common seal is basically the signature of the company. Even if you don't have the signature of the company common seal, then alternatively it can be signed by the managing director. Even that is accepted. That's why they told the word may or may not. Any problem here? Online people, any problem here?
No, sir.
No, sir.
No, sir.
So let's slip in for a quick
sir.
break of
8 minutes.
8 minutes. We'll come back and continue. Thank you. Yes, people, welcome back for the break. So let's continue. So the next discussion point is difference between the partnership concern and the company's concern. So please, this is very important. Kindly pay full attention. Mode of formation. How does a partnership come into existence? It is a setup by agreement among the partners. A partnership comes into existence by having an agreement. The agreement can either be oral or it can be in writing. It can be in any form. There is no compulsion by the law that the agreement has to be only in writing. It can be in any way, but agreement has to be there. Second point is registration compulsory in partnership? In partnership, is it compulsory to register the deed with the government? No. Registration is not compulsory under the Indian Partnership Act 1932. When I talk about registration, I'm talking about registering with the government authorities. Whereas a company is set up by the registration under the Companies Act 2013 or under any previous Companies Act. The companies will be registered. It comes into existence only if you follow the step-by-step procedure which has been laid down either by Companies Act 1956 or Companies Act 2013. Second, Regulatory Act. Sir, this partnership business is there, no? If they have any problem, to which rule book they will refer? They will refer to the rule book Indian Partnership Act 1932. For example, we face one problem. In the absence of partnership deed, what will be the share of profit? Equal. Who gave this? Indian Partnership Act said that. Indian Partnership Act said that in the absence of partnership deed, profit sharing ratio will be equal. In the absence of partnership deed, IOC percentage will be 0. In the absence of partnership deed, IOD percentage will be 0. In the absence of partnership deed, loan by partner percentage will be minimum
6% per annum.
So this was a problem. So who gave a solution for this problem? The rule book called as Indian Partnership Act 1932. So what is the rule book of companies? If companies, that is one person company, private company or public company, if they have a problem, which rule book they'll refer to? Companies Act 2013, which is the latest act, which is latest law. Yes.
So if company act was again revised, why not partnership act, sir? Still old 1932.
The question is, sir, okay, it's a good question. Sir, Companies Act, they have revised 2013 latest law. Indian Partnership Act 1932. First of all, nobody modifies this Indian Partnership Act 1932. People are least bothered. Government also is least bothered. 1932 old act, I agree. But they should have revamped. They should have done a significant revamp. Now, why it is not done, we have to ask government only. Because government is least bothered. Now, government wants everybody to form a company because they are good earning for government. In partnership, nothing is there for government. Protest. Number of members. Now. Minimum number of partners is 2. Guys, in partnership, minimum is 2. Maximum is 50 as per section 464 of the Companies Act 2013. Now, look at this. Look at the plight of Indian Partnership Act. Who is giving the maximum limit? Companies rule is giving the maximum limit. The rule book of the Companies Act is giving the maximum limit. So maximum limit that is being given, the maximum limit that is being given is 100. In that, the central government is empowered and utilized and said that currently the maximum limit that we're keeping is 50. So minimum 2, maximum is 50. Any problem? Now, listen to me very carefully. In case of company, guys, there are 3 types of company. Shh. One is OPC. In OPC, minimum number of members. Members means owner. In OPC, name itself is 1% company. So minimum owner is 1. For private limited company, okay, this is minimum, okay? Maximum.
1.
For OPC, minimum 1, maximum also 1. Any problem? For private limited company, minimum is
2.
2. 2 people at least has to be there to form a private limited company. Maximum is
200.
200, subject to terms and conditions. What is the terms and condition? 200 excluding its present or past employee member. Now this point you will not understand. Next class I'll be discussing about private limited company. That time I'll give you a couple of examples to make you understand this concept. And all those who have said that I've studied this in BST 11th standard, I will shoot out the question to all of you. So be prepared. No. Second is public limited company. In public limited company, if you want a public limited company, minimum 7 members, maximum is unlimited. Any problem, online people?
No,
No,
sir.
sir.
No, sir.
No, sir.
In case of public company, minimum number of members, owner is 7 without any maximum limit. So maximum is unlimited. In private company, you must at least have minimum 2 members, but not more than 200. In 1% company, only 1 member. Minimum also 1, maximum also 1. Any problem? No problem. Liability, I'll not be discussing in detail, just short, crisp discussion, because I'll be discussing about liability in detail probably in 3rd lecture. Very important, please do not miss it out. Liability of the partners are unlimited. Point number 1. And all the partners are jointly and severally liable. In the very, very first class of the partnership, I gave you this line. I told you, if the question they ask in board exam or the CA foundation exam, what is the liability of a partners? You mentioned 2 points. The liability of a partners in the partnership concern is unlimited, and all the partners are jointly and severally liable. These 2 points is very, very important. If you get a 1 mark question for CA foundation people, 1 mark question. What is liability under partnership act? 1 mark question. You like these 2 points. Same way for 12 CBC people also. Now, this point I'll not be explaining here because I'll be discussing in depth in the 3rd class. Distribution of profit. Profits are distributed as per the terms and condition of partnership deed. If the partnership deed is there, in the partnership deed you'll mention, no, ABCD will share all the profits in the ratio 5:3:2. So in that ratio, you have to distribute the profit. If the partnership deed is silent, then equal. If the partnership deed does not exist. But I told you, in companies what happened, we use the fancy word. Now in company, the word profit is there, no? We don't use the word profit. It is called as dividend or shares. It is called as dividend. So distribution of dividend. The profit is being termed in the Companies Act as a dividend. Now, how do you distribute the dividend? In company, the company is managed by whom? The board of directors. The board of directors comprises of managing directors and the several other directors. So the board of directors decides how much dividend is to be paid. Now, I'll be discussing about the dividend in a very in-depth manner in the upcoming classes. Shortly, I'll tell you, dividend is nothing but share of profit. This is divided into 2 types. One is called as interim dividend. Second is called as final dividend. Interim dividend means what? The dividend, the profit which is distributed somewhere in the middle of the financial year. For example, let's suppose I have invested in some XYZ company. Now it is August month. So in that particular company, that company is giving me an interim dividend. So let's suppose I have purchased 1000 shares of that company. That company said that I'll give you 1 rupee as dividend per share. So into 1 rupee means what is the profit I got? 1000 rupees. So this is a profit of a particular period. Let's say first quarter, April, May, June. Or it could be the profit of the second quarter, July, August, September. So interim dividend means what? Once in every quarter, they will give the dividend intermittently. Why? To encourage us. You invested money. So if you get early profits, will it not be motivational for you? I tell you one live example. There's something called as Vedanta Limited. You know, you've heard this company Vedanta.
Yes, sir.
Sterlite, you know. Sterlite, everybody knows. Sterlite is known to a lot of people. Why is Sterlite known to us? Because of the pollution that factory emitted. And which city Sterlite is limited to that? Tuticorin. So, can I disclose one point? I was one of the audit, not partners, who's partners of Sterlite. I was one of the auditor of Sterlite's sister concern. So I happened to be there in Sterlite in Thoothukudi. So in that factory office premises, we were working as an audit team. So we used to be there typically in the month of April, May, or June for a period of 2 to 3 weeks for doing the auditing purpose. So that's how I know Sterlite in and out. So I visited their factory. We stayed there in their clubhouse and all. So Sterlite is a chemical company. It is a Vedanta is a big concern. In that, there's a multiple company. Sterlite is one such big company. Vedanta is led by whom? Anil Agarwal. He's the chairman, director of the Vedanta entire group. Like that, he's got multiple companies. In that, one such company is Sterlite. So Sterlite in Thoothukudi, what happened is it emitted a lot of pollution, which caused the nearby residents. It was very difficult for them to live there. So that's why what happened? The factory is now sealed. The factory is now sealed. It's been a couple of years. The factory is not operational. So now the best part of Vedanta is that recently, since COVID, this company started paying excellent dividend. Excellent dividend started paying at as good as 30 rupees per share to 60 rupees per share. A lot of people started investing in Vedanta. So what attracted them to invest in the company? The dividend what they paid. So the 60 rupees they paid in one shot? No, they paid in multiple parts. So interim dividend 1, interim dividend 2, interim dividend 3, then final dividend. So interim dividend means what? The dividend that is paid in between the financial year. Final dividend is paid when? At the end of the financial year. When do you distribute the profit? If you remember, I've discussed this concept with all of you. You do the accounting on day-to-day basis. On 31st of March, is your accounts 100% ready? No. Your accounts will get ready in the next financial year in the month of April, May, June, depending on how big your business is or how big your accounting team is. Correct? No? So somewhere here, you will exactly get to know what is the profit of this period. And that is the period when the profit partners can take away the profits from the business. Same way, guys, the company will run for the entire year. Somewhere in the next year, April, May, June, July, they will get to know what is the final dividend to be paid for this year. That is called as final dividend. Listen to me very carefully. Interim dividend, how much dividend to pay who to whom is been decided by whom? Board of directors. So, board of director proposes. You know what is meaning of propose? Not that propose. People, when I say propose, they have their own imaginary dream. They go into their past. No. Proposes means what? Recommended. Board of director recommends that so much of dividend should be paid. And this has to be approved. So, in case of interim dividend, proposal is done by board of directors and approval also has been done by board of directors. But in case of final dividend, the proposal is done by board of directors and the final approval is done by the shareholders in the annual general meeting. About this also I'll be discussing in deep in the upcoming concepts. To be more specific, in the third volume, when I discuss the financial statement format, that time I'll be discussing the concept of interim dividend and final dividend in detail. So dividend is of two types: interim dividend and final dividend. Interim dividend, who proposes? Board of directors. Who approves it? Board of directors. But final dividend, who approves? Sorry, who proposes? Board of directors. Approved by shareholders in the annual general meeting. So what is annual general meeting? Everything will understand. The board of directors decide how much dividend is to be paid. Interim dividend is declared by the board. Declared means what? Approved by the board. While proposed or final dividend is approved, declared or approved by the shareholder. Somebody called me. Sorry?
The final dividend is approved by major shareholders.
Final dividend is approved by the shareholders. Now, how it has been approved? Obviously, major will be approving. The majority of them will be approving.
Generally, who are the owners of the company?
100%. Am I clear? Any problem till this? So, in the case of company, the profits is distributed in the name of dividend. How many types of dividend? Interim and final. Very good. Can somebody tell me what is the meaning of audit?
Auditing.
Auditing is auditing. Audit means what?
So
Checking.
launch of the company.
Checking. Now, guys, in a company, supervising is right term. In a company, what happens? The accountant does the routine work. Mistake can happen two ways. Either he can by mistakenly make the mistake, or he can do it purposely. So what company means Companies Act. Companies Act, the rule book says that a company has to compulsory get its accounts checked, audited by a chartered accountant. It is mandatory. So checking of the accounts is compulsory under the Companies Act. Audit of the book means checking of the books of accounts. So where I said, I went to Sterlite, one of the group sister concerns of Sterlite, I went. So what did we do there? We used to do the post-mortem. What is post-mortem? The accounts which is done, the accounts which is dead. We used to tear all the ledgers apart. What is there in this ledger? What is there in that ledger? Why this is debited? Why that is created? Where is the bill for that? Where is the bill for this? Like that, we go and do the checking of the accounts. Correct? So auditing of the book means nothing but accounts which is being completed. That account is being checked by the chartered accountant, and this is compulsory under the Companies Act. In Partnership Act, is auditing compulsory? Not at all. Partnership Act 1932. Partnership Act 1932 does not compel to do the audit. Audit of the books is not mandatory in the Indian Partnership Act 1932, whereas it is compulsory in the Companies Act 2013. That's why a person who wants to start a business has to be very, very careful, because when you start a company, when you start a business in form of a company, it comes with a minimum expenditure every year, irrespective of whether your business is started or not started, whether you're in profit or loss. You have to incur constantly certain expenditures. So you have to be very, very careful and thoughtful before you start a company. Management. Business may be managed by all the partners or by any of them acting on behalf of all the other partners. If there are three partners, all the three people can participate in the management of the business. Or these two people will say, we are going and sleeping at home, you alone manage. So this person is acting and making the decisions on behalf of all the three people. Whereas in the public company and private company, when there's so many people, so many owners, do you think everybody can manage the business? No. So these people will elect the representatives, and those will be managing the business. So business is managed by the directors, who are the elected persons of the shareholders. So shareholders are the owner, but they cannot manage the business. They will appoint the directors, and the directors will manage the business. So in partnership, owner directly manages Khan, whereas in companies, the owners cannot directly participate in the management. They are electing the representatives called as directors, who will participate in the management. Next is transfer of shares. Partner can transfer his profit share to other person as provided by the partnership deed or with the consent of all partners. So if you transfer of share means what? CPSR. What do you mean by CPSR? Change in profit sharing ratio between existing partner, which means what? A, B, C are three partners. D is coming inside the business. So he is taking the profit completely from A, or half of A's profit is taking. So what is A doing? A is transferring half of his share to D. So that is transfer of shares, no boss. In CPSR, sorry, we gave example of admission. Sorry, CPSR, what happens? ABC are three partners. Ratio was 5:3:2. Now the new ratio they want to make it 3:5:2. 3:5:2. So now what happened? Earlier A was enjoying 5 share of profit. Now he's enjoying only 3. So that 2 share of profit, what does he do? He transfer it to the other people. He transfer it to the other people, which is B. If it's admission, I gave you the example. Same thing follows. So a partner can transfer his profit share to other person as provided in the agreement. So CPSR, admission, retirement, death, what is it, boss? It's all transfer of profits only. Transfer of share of profit. Transfer of shares in companies, how it happens? In OPC, can you transfer shares?
No.
In OPC, can you transfer shares? Not possible.
No, sir.
OPC, one person, only one owner. When the company is born, he is the owner. When the company dies, he is the owner. He can never transfer the share. That is a restriction which I'll be discussing in the next class. Next is private limited company. Can he transfer the shares? Can the member of the private limited company transfer the shares? Yes, subject to terms and conditions. What is the condition? The procedure for transfer of shares with all the terms and conditions should be laid down in AOA. AOA stands for Articles of Association. Public company, there are two types: listed, unlisted. For listed companies, you can freely transfer. For unlisted company, you can transfer subject to terms and conditions. Except in case of unlisted and private companies, that is unlisted public company and private company, except these two, transfer of shares is not restricted, which means you can transfer the share. One more point they missed to say. except unlisted, private, and OPC. Transfer of shares is not restricted. What are they trying to say? Transfer of shares is not restricted except in case of unlisted public company, private company, and OPC, which means what?
Listed company.
So listed public companies, you can transfer the shares without any restrictions. For all the other cases, which is 1, 2, and 3, the restrictions is there. But for private and public company, which is not listed, the restrictions is there, but the restrictions are very easy. You can transfer it, but subject to terms and condition. OPC, you cannot even transfer. Am I clear with what I'm trying to say? Online people, am I clear with what I'm trying to say?
Yes, sir.
Yes,
Yes.
sir.
Business
Yes, sir.
partnership can carry on any business if all the partners agree. So let's suppose I started FFLA with the intention to provide coaching classes. Then slowly I started to see that a lot of you have craving in food. Like me, all of you are foodie. Then why my thought process came. Inside one extra room is there. In that room, if I put a staff, coffee, tea, bhaji, bonda, everything, if I start extra income. So now all the partners decided, apart from coaching business, let's also do snack business. So a partnership can carry on any business, that is coaching business plus snack business, if all of them agree. There is no restriction. You don't have to get permission from anybody. But imagine if FFLA is the company, either private or public. So I started this FFLA with the main objective of providing the coaching classes. Now, suddenly, if I want to start a snack business separately under the same banner, I cannot do it that easily. I have to follow some rules and regulations. What are you supposed to do? A company can carry on only that business which is permitted by the object clause of MOA. Now, what is MOA? I'll be discussing in the upcoming class. In the MOA, Memorandum of Association, there's one particular clause called as object clause. In that object clause, you have to tell the government that what is the objective of you starting FFLA? What is the objective? Provide coaching classes for 11th and 12th. What is the objective of Kalpavriksha Academy? Providing the professional coaching classes of CA, CS, CMA, ACCA, CFA. If I deviate from that, am I allowed to deviate? Not possible. Possible when? If you go and amend the objective clause and resubmit the document to the government. So object clause is basically one of the clause of MOA. MOA is a document that you have to submit to the ROC, that is government, while you register a company. So you said that initially you want to start a coaching business and you submitted a MOA. Now later, after 1 year, if you want to also start a snack business, you have to resubmit MOA telling that, sir, along with the coaching business, now I intend to do the snack business. So kindly allow. Like that, you have to update the object clause of MOA, resubmit the document to whom? ROC. Once ROC approves, then you can start the snack business. Little complicated. In partnership, no complexity. Going to start snack business, next second I can start. But in companies, what happened? You have to follow some extra procedure to ensure that you can do whatever you feel like doing. Yes, boss.
Are you planning to start snack?
Why not? Binding up. A partnership may be bound up by an agreement or by an order of court. If you want to, wound up means, guys, the term winding up is not there in partnership. The word is dissolution. The dissolution of partnership can be done upon an agreement. All the three partners put together can decide, I want to close the business. So they will execute the agreement and close it. Or the court will order. We have studied various cases under dissolution when the court can order for dissolution. So upon that, the firm can be dissolved. In case the firm is unable to pay its debt, then Insolvency Act is applied. Forget this. Now, a company can be wound up only by the process prescribed in Companies Act 2013. See, in partnership, what happens? One fine morning, we got up and all the three partners decided we want to close the business. Next second, you can close the business. Not too many complexity. Just current partnership deed, contract, everything you cancel, little bit of paperwork done. But in Companies Act, you cannot do that. You have to follow all the procedure that is laid down in the Companies Act 2013. The list is huge. There's so many compliances that you have to do, upon which only legally a company can be wound up. Otherwise, it cannot be wound up. So the complexity in closing the business company is quite large. Stability of the business. The partnership business is affected by the death of a partner or a retirement of a partner or the insolvency of a partner. Unless mentioned otherwise. If the agreement mentions upon the death of a partner, upon the retirement, upon the insolvency, the business will still continue. And if everybody signs it, then probably you can continue. But if that clause you forget to mention, you have to compulsory dissolve it. So the business is affected by the death of a person, retirement, and insolvency. Whereas, since the company is enjoying perpetual succession, in that case, the death, insolvency, and the transferability of the shares of the company do not affect the continuity of the company. Any problem here? My dear friends, any problem here?
No, sir.
No, sir.
No, sir.
Fantastic.
No, sir.
So, 2 more classes, guys. 2 more classes on the theory part, which is very important. I cannot bypass this. So please cooperate. Very important from the examination point of view. The real essence of doing the question, guys, you'll get it only when you understand this theory. And once you do this theory, I'll be asking a lot of theoretical questions while doing the practical questions. Only if you're able to answer, that means that you've listened to the theoretical classes properly. So don't think that I'll not check upon your theoretical aspect. I'll very strongly check on the theoretical aspect because I'm spending 3 crucial classes on theory. Very, very important. So please concentrate. And specifically, my lot of questions go to online people. So be prepared. So yes, people, that's all from mine for today's session. I'll see you in the next class, which is Monday, 6:30 p.m. sharp. Until then, bye-bye. See you. Take care.
Thank you, sir.
Thank you, sir.
Thank you.
Thank you, sir. Good night, sir.
Thank you, people. Thank you.
Thank you, sir.